is the president right? If there were to be an impeachment, hypothetically, would stocks sink, or is this a Teflon stock market? Ryan Detrick is the senior market strategist with LPL Financial, and Brent Schutte is the chief investment strategist with Northwestern Mutual Wealth Management. Gentlemen, thank you guys both for being here. Ryan, we're going to start with you. There is this idea out there that the markets are Teflon, that there's nothing that can take them down. Is that, in fact, the case, and is the data historically there to support it?
Well, Dom, first off, thanks for having me back. But, should that news come out on the president, of course there could be some downside volatility, but that's what we don't know. What do we know, Dom? Well, the S&P is right at the January peak, right? We've been up almost 4 months in a row here on the S&P 500. We're entering the troublesome season of September and October during a midterm year. So a pullback could be very likely. But, Dom, what do we also know? Sell and may go away isn't working this year. The S&P is higher April, May, June, July, and potentially could be higher in August here with 1 week to go. We took a look at what does that mean. The final 4 months of the year, Dom, have been higher every single time, 5 out of 5 times since 1950, up about 10% on average for the S&P. So the fact sell and may go away is not working could be a really good sign. Yes, there can be volatility still, but the bulls really could still be in control the rest of this year.
Go ahead.
I was just going to say, Brent, let's bring you to this conversation. With these seasonal tailwinds in place, is it a time when investors and some of your clients should be looking at perhaps adding to exposure, or is there more caution in your voice right now?
Well, there's certainly a little more caution as you go through an economic cycle, and we are getting closer to the end, but we're not there yet, so we do think there's future gains. I guess as far as the president, I think a correction could happen if he does get impeached, but I would note and take exception to his comments about a crash. He mentioned the consumer and actually the consumer being poor. I think that's not likely because the consumer have saved much more money and their debt to equity levels are back to 1987 levels. And I usually think a crash is associated with something done to the consumer. And right now I don't see that happening. And so broadly speaking, the economic fundamentals, even if the president were to get impeached, still remain in place. And we do believe that eventually pulls markets with it. And so while there may be a correction, it's unlikely that it'll be a crash, and we do think higher highs are in the future.
So Brent says correction, not crash. Ryan, how much of this stock market and the gains that have happened over the last almost 2 years are directly attributable to Mr. Trump?
Well, that's a great question. We think what's probably more attributable is the fiscal policy that obviously President Trump brought in. Tax reform's been a big deal. That's the big question, Tyler. Is this just a couple quarters of good economic growth and stock market gains because of the fiscal policies that have been in play? The LPL research, we think no. We think this is going to expand. Look at the productivity number we saw last week. CapEx is coming back what we saw in this recent earnings season. Yes, this is an old economic cycle. We think it can extend. And let's talk about market technicals just for a second. There's this theme that only a few stocks are leading the market higher. When we see the NYSE advanced decline line making new all-time highs, along with the value line arithmetic index, which is like your average stock out of 1,700 stocks making new all-time highs, there are a lot of stocks participating. That is a sign of a healthy market, not an unhealthy market.
Brent, let me turn back to you. Impeachment is something that is way, at the very least, way over the horizon if it ever actually comes to that. But between now and whatever point that is, there are other worries in the market, aren't there, including slightly incipient inflation, rising interest rates, the potential of something that worries the Fed, and that is trade friction. Aren't those much more sort of proximate concerns to investors than the other one?
Absolutely. I mean, I think what I worry about most is rising inflation and a bond market which is currently ignoring it. And so if you can recall back to the beginning of the year before we started talking about tariffs and worrying about them, the market correction was really driven by rising inflation expectations and a rising 10-year Treasury, which caused stocks to have to reprice. And I worry that in the future, at some point, bond yields have to bear some semblance to reality with what current inflation is. And so that may cause the correction that could come in the interim term. I guess the most important thing I keep pointing back to is that I do think, and even though the president said Jerome Powell is being too tight, if you look at current monetary policy, real interest rates, it's not nominal, it's real interest rates in this country are still negative on every single measure of inflation. And I challenge you to show me some time period in the past where real interest rates are this negative this far into the cycle. And I think societally, the Fed has changed. Inflation is no longer the boogeyman as it once was back in the 1970s and 80s after that inflation. And that was the Fed's biggest concern. They fought it every single time. It was the enemy always worth fighting,
right.
And they would maybe sacrifice economic growth for that. I think the enemy is not deflation, and so I think the inflation leash is much longer.